What if you could predict a recession before it was officially announced? Usually, by the time everyone agrees the economy is in a recession, the damage is already done. The National Bureau of Economic Research, NBER, is the group that officially dates US recessions. But they do so by identifying the peaks and troughs in the business cycle using historical data. In other words, official recession dating isn't designed to be a real-time warning system. By the time a recession is announced, the worst is usually over. In fact, it's often a better buy signal than a sell signal. The stock market is forward looking. It cares about what will happen, not what has happened. So, when the announcement hits, earnings have already bottomed out, the damage is priced in, and the worst is behind you. At that point, you might as well buy. So I wanted to test something. Can we predict recessions before they are officially announced? And more specifically, can you rebuild the New York Fed's famous recession probability model in Python and beat it with the more advanced machine learning algorithms and data pipeline? In this video, I'm going to be showing you three things. First, how the yield curve predicts a recession. Second, how to rebuild New York Fed model from scratch in Python. Third, whether a machine learning model using better leading indicators can actually beat it. The classic New York Fed model is surprisingly simple. It doesn't use hundreds of economic indicators. It focuses almost entirely on one thing, the yield curve. The Fed has published extensive research on the predictive power of the yield curve. If you're interested, I will leave a link in the description below. They are highly transparent about their inputs and methodology, so reverse engineering and re-implementing it shouldn't be too difficult. Like most governments, US government spends more than it brings in, so it has to fund the resulting deficit with debt. To do that, they issue treasury bills, notes, and bonds. The yield curve simply shows the interest rate government pays to borrow money over different periods, whether it's 3 months, 2 years, 10 years, or 30 years. Each maturity comes with a different rate. These rates are determined by the market participants and vary based on the macroeconomic outlook. For instance, if investors are pricing in higher inflation, they will demand a higher yield to compensate. Normally, long-term rates are higher than short-term rates. This makes perfect sense. If you lend money over 10 years instead of 3 months, you want a higher return to account for the uncertainty and risk over that decade. In functioning capital markets, higher risk requires a higher reward. Because of this, normal yield curve slopes upward. But before almost every major recession, something strange happens. Short-term rates rise above long-term rates. This is called an inverted yield curve. Inverted yield curve is an unusual state in which longer-term bonds have a lower yield than short-term debt. The New York Fed model focuses specifically on the spread between 10-year Treasury yield and 3-month Treasury yield. When this number is positive, the yield curve is normal. But when it dips into the negative, the curve is inverted. Historically, that inversion has been one of the most reliable warning signs that a recession is on the horizon. So the first thing I did was rebuild this model from scratch. I pulled Treasury yields going back to 1959 and calculated the 10-year minus 3-month spread. After that, I trained a linear model to answer one core question. Based on today's yield curve, what is the probability that the US economy will be in a recession 12 months from now? That gave us our baseline, the classic yield curve recession model. And honestly, it works pretty well. In my backtest, the simple baseline reached an AUC of 0.77. It caught a significant amount of recession risk, though it was a bit noisy and threw few false positives. But overall, our recreation of the Fed's model was highly accurate and matched their benchmarks closely. So I asked the more interesting question, can we beat it? To test that, I built a machine learning model and fed it a much broader dataset. Building permits, jobless claims, consumer sentiment, unemployment, credit spreads, inflation metrics in multiple different segments of the yield curve. Before building, I needed to settle a critical design choice. Model architecture. What kind of model should I actually use? Should I stick to a simple linear model like the Fed, or should I go as complex as a deep neural network? I figured a tree-based model would be the perfect sweet spot. Going as simple as a linear network would oversimplify the problem, especially since most economic conditions are deeply nonlinear. On the flip side, jumping straight into a complex neural network or a transformer would almost certainly lead to severe overfitting on our historical timeline. a gradient boosting tree model offered the exact balance of complexity and stability I needed. But during my first attempt, I learned a brutal lesson. When I ran the backtest, the AI model completely missed the 2008 great financial crisis. Why? Because it fell into the unemployment trap. The machine learning models love strong correlations, and historically, the unemployment rate is heavily tied to recessions. The problem is unemployment is fundamentally a lagging indicator. In 2008, the financial crisis was triggered by a systematic issue in housing and credit markets, not by initial failures in the labor market. Companies didn't start firing employees until they were already losing money. By feeding AI lagging data like raw unemployment rate, the model became lazy. It sat around, waiting for unemployment to spike before ever declaring a recession, meaning it completely missed the flashing warning signs coming from credit spreads and housing in 2007. To fix this, I completely redesigned the data pipeline. I stripped out the lagging traps and forced AI to strictly rely on leading economic indicators, metrics that fundamentally shift before the rest of the economy turns. We are talking about forward-looking data like momentum in building permits, shifting consumer sentiment, and specific mid-curve yield spreads. And when I ran the expanding window backtest, the results were absolutely insane. First, let's look at the overall accuracy using the AUC score, where 1 represents a perfect crystal ball and 0.5 represents a random guess. The classic Fed baseline achieved a respectable 0.77, but our upgraded leading indicator AI model hit an incredible AUC of 0.94. While standard metrics like AUC look great on paper, they don't tell the whole story. The true breakthrough of this project comes down to eliminating the boy who cried the wolf effect, false alarms. The fundamental flaw in traditional models, including the Fed baseline, is that they are noisy. Because the underlying bond yields constantly fluctuate with day-to-day market sentiments, a standard yield curve baseline spends a lot of time constantly signaling an imminent crash when nothing is actually happening. In fact, if we have traded the yield curve inversion over the last 30 years, you would have sat on the sidelines in cash for roughly 1500 days, over 4 full years, completely missing out on major historical bull markets like 2024. Our upgraded AI model essentially eliminates the noise. Instead of constantly floating at elevated, anxious levels, the AI model stays mostly flat and quiet. This makes the signal much more meaningful. When the AI model finally does spike, it provides an undeniable warning that a structural market shift is coming. By dramatically lowering the overall error rate, we turn the noisy macro indicator into a highly reliable, actionable signal. So, how does the AI model pull this off? What is it seeing that the traditional models, like the Fed one, completely misses? If we look at the feature importance chart for our model, the results are interesting. The classic 10-year minus 3-month spread that the Fed relies on wasn't even a top 5 driver. Instead, the single most important predictive feature was 6-month change in building permits. When you think about it, it makes sense. Housing is the bedrock of the US economy. When developers stop pulling permits to build new homes, it means capital is tightening and forward-looking economic demand is drying up, months before it ever shows up in GDP or unemployment data. The second most important feature was 5-year minus 3-month yield curve spread, followed closely by 12-month change in consumer sentiment. By combining housing momentum, consumer psychology, and multi-segment yield spreads, the AI built a multi-dimensional view of risk that a single yield curve spread model cannot capture. The main caveat of this model is data revisions. Some macroeconomic indicators are revised weeks, months, or even years after their first release. So if I train and backtest a model using today's finalized data, the model may be seeing slightly clearer information than investors actually had in real time. That creates a small hindsight bias, and it means that the backtest results may be overinflated. I tried to reduce this by choosing features that are revised less aggressively and by relying more on market-based data like yield curve and credit spreads. But no macro model is safe unless you use vintage real-time data. Thank you everyone for watching. I hope you enjoyed the video and found it useful. All the code in this video is available on GitHub, and you can run your own deep dive data analytics on macro, stocks, and options over perspicium.com. Both links are in the description below. If you enjoyed the video, smash that like button and subscribe for more quantitative research. Drop a comment below with what you want me to backtest next. Thank you for the support, and I'll see you next time.